Good morning and welcome to the Click and Go podcast for Friday the 9th of October. We've seen a material rebound in confidence this week from the very low ebb we were talking about last week. And it's been driven really by a recovery in the Asian markets that have actually seen their follow through into the developed markets. So here we've got an example of that with the topics and the which is obviously the Japanese market and the S&P 500. They're very closely correlated at the moment, and typically the S&P would be leading the Japanese or the Chinese markets, but it's the other way around at the moment, which is reflecting what people are nervous about. That rebound in those markets has come because the economic data has stopped deteriorating. So here we can see that rebound in the Chinese data in terms of the economic surprise index, which we talk about a lot. But we've also seen a sort of trough in the emerging market data there. And equally, the oil price has rallied. So we've seen quite a big move above $50 a barrel in the price of Brent crude. And with it, that's taken the 10-year gilt yield up higher as people get less worried about growth and factor in the possibility of interest rates rises, so therefore you see the yields going up and the yield curve steepens. Emerging market currencies have also benefited from better commodity prices and more confidence in those economic numbers. So we've seen those currencies started to rally against the dollar. That's obviously been helped by the Fed's decision to leave rates on hold in the States. So we'd expect this rally to have legs into the year end. We've had a significant growth scare over the last few weeks in summer, and that's taken sentiment to very low levels. So people are not really positioned for this rally at the moment. And particularly they're not positioned in the emerging market facing stocks or the emerging markets. So you'll see the beta or the bulk of the early stage of the rally coming from the emerging market stocks or those who are selling into those emerging markets, because as you can see here, there's been a huge differential in performance between those stocks. So within the Killik list, we probably pull out names like Intercontinental Hotels, Prudential, Aberdeen, Rio's, Shell, which we updated the buy note on this week as stocks that should move well as people get less concerned about the growth outlook in emerging markets. So going into next week, we've got a real pickup in the reporting season. So we had Alcoa last night who missed their results, and next week we'll get a real depth and a real feeling in terms of how the US reporting season in Q3 is going to go. So key interests to us are obviously Johnson & Johnson on Tuesday. We've got Marston's in the UK on Wednesday. Wells Fargo will be a big number. That's the first big US bank, after JP Morgan on Tuesday reporting. Then we've got Goldman Sachs on Thursday, which I'll talk about a little bit. Unilever obviously on Thursday. With people less worried about the emerging market growth conditions, we see a movement probably back to more normal conditions in going into the end of this year. So that'll be a stabilization in terms of global markets. The weakening that we see in the US dollar and the recovery in inflation expectations does actually make it more likely, if we see a rebound in the employment data in the US, that we set up conditions for a rate rise in December. That'll be a key influencer for equity market returns in that sort of fourth quarter, because at the moment that's not priced in at all. One of the beneficiaries of people getting more positive about interest rates going up and economic activity in general will be Goldman Sachs, and they, as I say, are reporting next week. What we saw from Deutsche Bank this week was there is a rising need for capital in investment banking, and you need to be very well capitalized, which Goldman Sachs is. Deutsche Bank isn't. So you can see more market share going across to Goldman Sachs as a result of those capital requirements. And as I say, also rising interest rates in due course should help that stock. So we remain buyers of Goldman Sachs into their numbers, although expect some sort of volatility in fixed interest, which we've started to see in some of the numbers that we've seen this week. So thanks very much. That's it from me.